three big things of getting a loan approved is going to be income, your DTI, your debt to income, and your credit score.
Gotcha.
Yeah.
So like, what is the typical ratio? How do you calculate your own?
Yeah, so good question. So debt to income is very, very important. So what we're looking at is we're looking at your gross income on a monthly basis, and then taking all of your monthly debts and figuring out what that percent utilization, if you will, what that ratio is. So for an FHA loan, we're looking at 57% is kind of the magic number for DTI, debt to income ratio. So that's going to be your gross income with all of your expenses, and it's going to be all your expenses plus your new mortgage. Now, when we talk about all your expenses, it's going to just be your loans or any type of debt that you're carrying.
So things that show up on
a credit report. Absolutely. Okay. So it's going to be car payments, credit cards, student loans, any installment loans, furniture loans, boat loans, anything of that nature.
But like groceries,
gas, none of that takes into effect. Your light bill, none of that goes into your debt to income. Now, when we factor in your new mortgage, which is going to be added to that debt to income, we're going to be looking at taxes, insurance, HOA, flood, if you have mortgage insurance, principal interest, that's all going to be wrapped into it. And so we're going to look at all of your current debts and your new mortgage, and
add that together, and then divide that, or we're dividing the expenses, right?
Yes.
Like the mortgage cost, your expenses that are on, that would show up on your credit report.
Correct.
And then divide that by your gross monthly income. Right?
Correct. And then so for an FHA loan, that's going to be your percentage. For an FHA loan, we're going to look at about 57%. Now these are generalizations. Obviously, each situation is a little bit different, but for FHA, we're going to be looking at 57%, and there is a front end and back end ratios, which we won't get into today, but let's just generalize it and say 57%. And then for conventional loans, we're looking at 45% debt to incomes.
Alrighty, and so let's say you figured out your debt to income ratio, and like how big of a role does that play in getting approved?
Yeah, so that's huge. Yeah. So that's right up there with credit score. Okay. So if your debt to income is above 57, it's going to be hard to get approved. There are some programs that will allow it, but very specific situations. But yeah, that's huge in getting approved. Okay. Huge. And again, that's something that we can talk about, and how do we structure the loan so that we can get it approved.